The focus of this lecture will be the calculations of a securities risk. I am sure you know the code written in the first two cells and quickly understand what we are doing. The same libraries are imported, and data from Yahoo Finance is downloaded, saved in a data frame object called security data. We must pay attention that we are extracting the right companies and the time span of the extraction is correct. The two companies we have chosen here are P&G and its German peer, Beiersdorf. Hence, we will need the tickers PG and BEI.DE. We will examine the behavior of the two stocks for the past 10 years, retrieving data from the 1st of January 2007. Okay, perfect. Let's talk finance. The standard deviation of a company's returns can also be called a risk or volatility. A stock whose returns show large deviation from its mean is said to be more volatile. Right. So, let's see the stocks of which company are riskier or more volatile. First, we take the logarithmic returns because we will examine each company separately in the given time frame, and this approach will tell us more about the behavior of the stock. We will store this data in a new table called security returns. Okay, this newly created table has two columns. Each contains the log returns of P&G and Beiersdorf respectively. And this allows us to obtain the mean and the standard deviation of the two stocks for the data frame. To do that, abide by the following syntax. After the name of the object, which will be the data frame with the log returns, security returns, specify the name of the columns in brackets. Then, apply the method called mean. We obtained a small number. It equals the daily average return. Let's annualize this value, multiplying it by the number of trading days in a year, 250. Good. We obtained a value slightly above 6%, which is the annual rate of return. The same Pythonic logic must be applied to the calculation of the volatility of this company's stock. The method we will need is called STD, an acronym for standard deviation. To annualize this figure, besides multiplying it by 250, don't forget to raise to the power of 0.5. You will take the square root of 250, and you should not forget to do this, because the standard deviation is, per se, square root of the variance. Next, we repeat the same procedure for Beiersdorf. We get a higher mean, but also a higher volatility percentage. See? It would be easier for us to interpret the results if we quoted the two means and the two standard deviations, one next to the other, right? To achieve this, one way would be to print the equations of the two annualized means. And here's what we obtained. The second way is more stylish, but is trickier. From the security returns data, we could extract the mean of both companies after writing one line of code. We must enlist their tickers, separated by a comma. Apparently, this would not be enough, since the output of this cell shows an error. NumPy has the answer to this issue. The means and the standard deviations we obtained were all elements of one-dimensional arrays. They were also float values. Here, we are trying to include two values in a new NumPy object. There cannot be a floating point with two values, right? A float can only contain a single value. Therefore, we must create an array with two dimensions. Briefly, each pair of brackets we surround our column names with will increase the number of dimensions of the newly created NumPy object by 1. Hence, we can correct our code by using double instead of single brackets. In this specific lecture, we could have coped without using NumPy. But it is important you pay attention to the difference between using single or double brackets, because if you have to program advanced mathematical operations that involve matrix multiplication, for instance, this part of the Pythonic syntax will be problem solver number 1. We will make sure we show you such an example in one of our next videos. By using this technique, we can obtain the means and the risk values of both companies. This implies we have recorded the mean values of P&G and of Beiersdorf's returns as elements in one matrix and the values of their standard deviations in another matrix. This lesson reinforces what we learned in our previous lecture, right? Stocks with higher expected return often embed more risk. Beiersdorf's rate of return is slightly higher. However, this comes at the expense of a higher volatility. Thanks for watching.